Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, I want to talk about the most overlooked tax strategy. I can't stress enough how this tax strategy is very, very important for your business, and it starts from the very beginning. Once you have a business, once you start a business, you're looking for what kind of tax structure you need to have for your business. You can change it along the way, and that's what we're going to talk about. But the main thing that I want you to stress on and that I want you to understand is what type of entity is good for your business. Because the type of entity that you have may cost you a lot of money more than you think. All right, so let's dig in. Let's see what are the type of structures that are available out there and what would be the best for me, knowing and seeing the pros and cons and the cost and everything that's related to each one of them. All right, so let's just start. And as you know, I always like to start with a joke, and this is the one that I found related to different kind of taxes. You get hit by one tax, and then you just turn around and you find yourself hit by another tax. And that's part of what I want to talk about today. All right, so let's start. Business entity optimization, choosing the right structure for tax savings, because as we said, the wrong choice can cost you thousands every year. It's not just hundreds, it can cost you thousands. And that's from my experience working with a lot of clients coming to me. And when we analyze, when we do the tax strategy analysis, we say, no, you probably are not in the right tax structure. Or maybe you are, but you just need to know why it is. But what kills me is when you find like a friend or something that has this type of structure and it tells you, okay, you go and do the same like I did. It doesn't work this way. It's a case on case basis. So it's so different from one person to another, depends on your tax situation. All right. So why entity choice matters? Because depends on the entity. Each entity has different tax impact. Like the tax rates are different for each entity type. Deductions that are allowed, the compliance related to each one is different. It determines how you get paid, how you pay yourself from the business. So that's also different based on the entity structure. Retirement contribution, what kind of benefits, the limits for the retirement contribution. This can be different from one entity to another. And also there is some audit risk involved in different types of entity. So it impacts tax rates, how you get paid, so payroll, accounting, retirement, audit risk. It has a lot of different aspects. What are the main type of entities that are available out there? You have the sole prop, you have the partnership, C corporation, S corporation, and LLC. We'll go and dig in for each one of them. The sole prop, it is very simple to set up. It's very administrative wise, it's very low in cost. All the profits are taxed at the personal rates, and it is subject to self-employment taxes. We talked about this before. Self-employment taxes is when you hire, is when you like, as a W-2 employee, you pay portion and your employer pay portion of self-employment taxes, Medicare and FICA and all of that. Social Security. But when you have your own business, you act as both. You act as the employer and the employee, and you pay 15.3% in self-employment taxes, Social Security, Medicare tax. All right. So this is the sole prop is subject to self-employment tax. So whatever net profits you have, it is subject to self-employment tax. And it's very limited in the tax planning opportunities that are available for this type of a structure. That doesn't mean that there's nothing to be done on the personal level, but I'm talking about the business level. Fewer tax planning opportunities available out there. All right, next comes the partnership. The partnership is also pass-through taxation, meaning that you don't pay taxes on the partnership level. It passed through to the partners. They pay the taxes based on their tax rate. Also, there is self-employment taxes, but it's on most active income. So if you're not actively participating in the partnership, you don't pay self-employment tax. But if you are and you're actively managing it, then you pay self-employment tax on your net income. There is a flexible profit sharing between partners, and there is a joint tax liability. All right. So that's for partnership. Comes next the C Corp. The C Corp has a flat tax rate of 21%, and this did not change. It remains the same after the OB3A Act. It stays the same. So it's a 21% corporate tax rate. You don't pay, you pay taxes on the corporate level at 21% flat rate. There is a potential of double taxation because when you pay yourself, you either pay yourself as a loan and you charge yourself interest, or you pay yourself as dividends and you pay in the taxes on the dividends that you receive it based on your tax bracket. All right. There are more fringe benefits possible for C corporation, and you can retain earnings. Like if you want to expand as a business, this is also a good possibility. All right. S corporation. S corporation is also another path through taxation. So it's different from the C corp because you don't pay taxes on the corp level. You pay taxes on the individual level. So you get a K1 form at the end of the year where it would show you your share of the profit, and you pay taxes on it on your 1040 on your personal tax return. Salary is subject to payroll tax and distributions are not. So you can retain earnings, you can pay yourself distributions that are not taxable, but that are not subject to self-employment taxes, and it's not subject to income taxes like C Corp. So you avoid double taxation here and you avoid self-employment tax, but you still have to pay yourself reasonable salary. And that's like a discussion for another time, like how much is reasonable salary that you have to pay, because the reasonable salary, you pay the self-employment taxes or the payroll taxes on the reasonable salary. But it's lower self-employment because you don't pay on everything, you only pay on the payroll portion. With proper planning, this could save you thousands of dollars. What else? The LLC is the one that's very flexible. It gives you liability protection. So your assets personally is separate from your business assets. Same with corporations, by the way. But it's flexible taxation option because you can get taxed as an S corporation, as a sole prop, as a C corporation. You can get taxed in different ways. But it varies by the state. Every state has its own like fees and yeah, and like mainly fees that you have to pay and renewal and some compliance issues with each state. You can elect S corp or C corporation status, as we said. So if we want to summarize everything, this is a tax impact comparison table between the sole prop, partnership, C Corp, S Corp, and LLC. The tax rate for the sole prop is personal rate. It depends on your personal rate, and it's subject to self-employment taxes. There is no payroll. It's a very low in the tax flexibility, tax planning opportunities, and low also in admin complexity. As a partnership, it's also subject to personal to taxes based on your personal rate. It's passed through. You pay self-employment taxes on your active income, payroll maybe, but you pay yourself like mainly guaranteed payments. Tax flexibility is medium, same thing with admin complexity. C Corp, you pay 21% on the corporate level. There is no personal rate here. The personal rate goes only on the dividends, but if you retain earnings and you don't pay dividends, then it's only 21%. You don't pay self-employment taxes. There is payroll, and it's actually required. Same with the S Corp. Tax flexibility also is medium, and the admin complexity is high, and that's the disadvantage of having a C Corp. As corporation, you get taxed on the personal rate. You pay self-employment taxes on the salary only, and it has to be reasonable. So you have to pay yourself salary, payroll, and it's high in the tax flexibility. There is a lot of tax planning opportunity there, and admin complexity is medium. As an LLC, it really varies based on what type of election you're electing the LLC to be taxed at. Taxed as an S Corp or C Corp or partnership. It depends on this. It would vary based on all of that. All right, so it's the tax flexibility here is very high based on what type of entity you will be taxed at. And just a reminder that S corporation is not a legal entity. You can go and to the state and tell them you want to establish like an S corporation. S corporation is a tax structure, is not a legal structure. You start with a C corp or an LLC, and then you elect an S corporation status. All right, so choosing the right entity, key factors to consider when choosing the right entity. First of all, the profit level. Are you profitable or not yet? How much profit do you have? I'm not talking about gross income. I'm talking about net income. What is your profit level? Are you planning to reinvest and retain your profits, or you want to distribute it? You want to pay it back to yourself? The number of owners and the relationship between the owners, estate tax rules, because every state is different, growth and exit plans. Do you plan to sell your business in a couple of years or not really? Do you want to keep it for long term? So that's why we say don't just take an advice and somebody tells you that S corporation is the best and you go and do it on your own, because it may not be in your case based on all these factors. All right, so entity optimization, like I'm just gonna give you an example. This is somebody who made 200K in profit. As a sole prop, they pay 15.3% in self-employment taxes. As an S corporation, you save about 12K a year just in self-employment taxes. So this is just a very simple example of how much you may be saving just by choosing the right type of entity. Another person another client I got was a C corp, and we're able to save him like 40K just by changing to an S corporation status, because he had a lot of loans and these loans would be subject to either dividends, and he was not aware of the double taxation part, and he thought that he just can record it as loans, which is okay. Even if you record it as loans, do you know that you have to charge yourself interest? If not, then you're not in compliance and you're having an audit risk, and it's not right. So why not do it the right way, in a way that can save you taxes? So this is not just an entity that you want to establish. This is really a strategic decision that you need to consult someone professional to help you take that decision. When to review your entity? So let's say you already have an entity, but when can you review and consider changing your entity? Because there are in some cases, you can change from one structure to another. Definitely when your income changes, like if you start low and then you go up in your income, or the opposite, then you may need to reconsider what type of entity, because a lot of it isn't like just a tax election, that you can change it, not just from a legal standpoint. So you can review, you can change it if you encounter income changes, if you had to add or remove partners, if you're expanding away from your home state, if you're considering selling your business, if there is a new tax law like the 03BA, because with the changes in tax law, there may be some structures more favorable than others, and you may need to consider that. So with all these factors, you may need to change and review your entity. So if you're thinking that this was helpful and you think you're not sure whether you are having the right tax decision and the right tax structure for your business, I'm calling you to action. I'm asking you to give me a call. It's a free 30-minute consultation. We'll go over the tax structure of your business, and we'll tell you whether you are in the right spot or you may need to make changes. All right. Thank you so much, everyone, and hope to see you next week.